Good afternoon, everybody. This is me, Theodore, from the Yelling Values. This afternoon, I'd like to discuss with you on some of the basic, concept of the property valuation. Because recently, about 3 weeks ago, we've been engaged by a very big corporate company to value its assets. So its assets, comprises of investment properties, comprises of industrial properties and commercial properties, residential properties, a huge property portfolio that we, the young villagers, have been engaged, and then we carried out the assessment, the market value assessment for the entire property portfolio. And during that time, I've come across certain things that we as valuers need to make clear to our clients, so that our clients can really understand what we are doing. By saying this, let us look at some of the basic principle in property investment. Okay, first of all, there's all kinds of properties. It can be commercial property, it can be residential property, it can be industrial properties or agricultural property, all kinds of properties. Okay, regardless of these types of property, you will find out that some of the properties are occupied by the owner, and then some of the properties are rented out, and then some of them will be vacant. Vacant maybe because of the drop in the market or the economy, or maybe because of bad investment decisions. So when we talk about property and property investment, we can never isolate property investment from other investment. Say, for example, from 2014 to 18, we have seen the boom in the building industry. The real estate industry has experienced a boom. So that boom was triggered by the investment in the oil and the mining industry, especially the LNG. So now you see, most of the developers, property developers, they have seen the opportunity there. So they have approached the finances, the banks, and the financial institutions. And these banks and the financial institutions, upon seeing the boom in the mining industry and especially the mining industry and the revenue that it triggers, they went ahead and they fund those projects. So the property developers, they did massive investment in the properties. So when you talk about this, just an example. So when you talk about property investment, you cannot talk in isolation of the other investment. They are all interconnected. And then, so you see, what are the finances of this property investments? What are the finances? The client, you're basically the finances. When you get the loan, at first they'll tell you to, the bank will ask you to normally put 30% of the equity upfront. But in the long run, the bank will put 70%, but in the long run, who is repaying the loan? You are repaying the loan. In other words, you are financing the property. You are the financer of the property. Especially to the people, to the clients who are interested in venturing into securing big amount of loans to finance property. The very, very important thing you need is people who are good in doing financial analysis of the properties. You need them, especially the accountants and some of the most experienced valuers. You need them, because they will come in and then they will do projected cash flows, and they will do the projected returns of the property, and then they will assess the property as if completed in the future, and then this will put you in a better position for you to see whether property itself is good to act as the security, or whether the return, like 5 years from now after completion of the project, will be bankable or will be viable or not. This kind of people with these technicalities, especially financial technicalities, and those who can do financial analysis, especially the accountants and some of the values, you need them. One of the properties, the estates that we have inspected, there's all kinds of properties. There's office building there, warehouse there, it is recreational areas there, it is residential areas there. So it is a mixture of property in one estate. So they've asked me, so how are you going to assess all this according to the types of property? Okay, so that question leads me to this next point, which is the importance and the significance of property and property investment in the economy. So we as real estate people, we must be, this includes the valuers, the property developers, the property investors, the banks, and you, the client. We must know the significance and the importance of the property and property investment in the economy. So there are three main ways where you can signify, or you can identify with as to the importance of the property and property investment in an economy. First way, you can identify the importance of a property as a factor to the production. Okay. Secondly, you can identify that property, or the significance or the importance of the property, as a corporate asset. Thirdly, you can identify the importance of property and property investment as an investment. So what are those three? Let's have a look. Okay, firstly, property as a factor of production. So that corporate client that engaged us to value their property portfolio. In the property portfolio were warehouses and factories. One of them was a big coffee factory. So that property acts as a factor of production. The property itself, the factory, it provides space for production. This property now, it acts as a factor to production of the coffee. You see? So that is the importance of the property as a factor of the production. And then the next importance of a property is to look at the property as a corporate asset. So with the same corporate client that we've been engaged to value their properties, one of the big estates that we value comprises of 21 executive houses, standalone residential houses. So those 21 houses are occupied by their own employees. So you see, they have not rented the property out. They've given those residential standalone houses to their own employees to occupy. So now this estate becomes an asset to the corporate client that we wait for. So you see, and then that same asset has been used as a security or collateral with some of the other business loans that the company got from the banks. So now you can see the asset forms one of the major part of the company's asset value on their balance sheet. So a big portion of the corporate loan has been tied to that asset. So that is what some of the properties have been used for as a corporate asset. And then the investment, those that are seen as investment, which are important as investment assets. These are basically the properties that companies or individuals use to generate income, make income. So they own properties and then they rent them out. These are investment properties. So during valuation of such properties, that applies to all the properties, regardless of the type of properties. During this process, we as valuers, we are obliged to identify and distinguish three main things, which is the valuation, the ownership, and the valuation, the ownership, and the economic value of the property, which I will discuss maybe tomorrow in another video. So if you enjoy this video, please do comment below in the comment section. And yes, once again, if you need us to help you with valuation services, we the Yaling Valuers, we are always ready and available to be engaged in any valuation service that you need. You can contact us on the number that is shown on your screen right now, or if you don't see the contact there, you can inbox me directly, Theodore Tay, on my LinkedIn. Inbox me and we can reach out to you, and yeah, we take it on from there. You have a top afternoon, and cheers.